As we learned last night, U.S. President Donald Trump is determined to push his administration's trade policy overhaul.
Trade between Canada and the United States has reached such a critical point that many are now questioning. With friends like that, who needs enemies? Is Canada about to abandon the U.S. for its vehicle and metal exports and deepen its ties with the European Union? One Canadian lawmaker even went so far as to say, if Trump's threats continue, we will impose a 100% tariff on Elon Musk's Tesla. But how realistic is this? Can Canada truly shift its focus to the European Union? Or is this a high-stakes political gamble? Today, we analyze the deepening trade tensions, their economic consequences, and what this means for North America's auto industry. Before we begin, don't forget to like, share, and subscribe to Economy Explorer and support our channel by turning on notifications. Now, let's get into it. U.S.-Canada trade on the brink. Is this the end? For decades, Canada and the United States have maintained one of the closest trade relationships in the world. The two nations share extensive supply chains in the automotive, steel, and aluminum industries. This economic interdependence has fueled industrial growth, created millions of jobs, and facilitated the exchange of goods at an unprecedented scale. From major automobile manufacturers sourcing parts across borders to small businesses relying on seamless trade agreements, the deep integration between these two economies has shaped North America's economic landscape. However, the latest round of U.S. protectionist policies has left Ottawa in a difficult position. Washington's proposal of a 100% tariff on Canadian vehicles and metals has sparked outrage, with Canadian officials making it clear that they will respond in kind. These tariffs could have far-reaching consequences, not just for manufacturers, but also for consumers, who may see significant price hikes in vehicles, construction materials, and household goods that rely on steel and aluminum. The strain on the supply chain would inevitably lead to costlier production, reduced demand, and possibly even factory closures in both countries. What does this mean for businesses that have relied on seamless cross-border trade? The auto sector alone represents billions in trade value, with thousands of Canadian and American jobs at stake. Companies that operate on both sides of the border are now scrambling to assess the impact, with fears that prolonged trade restrictions could drive up production costs, disrupt supply chains, and reduce competitiveness in the global market. The complexity of modern manufacturing means that many car components cross the U.S.-Canada border multiple times before reaching the final assembly stage. A sudden shift in trade policy threatens to upend these processes, forcing companies to rethink logistics, relocate operations, or even cut jobs to absorb the financial impact. Additionally, businesses that depend on the steady flow of Canadian metals into the U.S. construction and defense industries could face setbacks. Higher tariffs would increase project costs, potentially slowing infrastructure development and weakening economic growth. At the same time, Canada, seeking alternative buyers, might be forced to strengthen ties with the European Union and other global partners to offset the damage. The longer this trade dispute drags on, the greater the risk of long-term economic fragmentation between these historically allied economies. Tesla in trouble, a target in the trade war. Tesla has unexpectedly found itself at the center of this trade war. Canadian lawmakers believe that by targeting Tesla, they can deliver a direct blow to one of America's most recognizable brands. But is this a sound economic strategy or just political posturing? Tesla has a significant presence in Canada, both in terms of consumer sales and potential investments in the raw materials sector for electric vehicle EV batteries. If Canada imposes a 100% tariff on Tesla vehicles, the company could see a drastic drop in Canadian sales, making EVs even more expensive for consumers. Additionally, supply chains for EV components, including lithium and nickel, could be impacted, forcing Tesla to seek alternative sources that might not be as cost-efficient. Beyond just vehicle sales, Tesla's broader operations in Canada could also take a hit. The company has been eyeing Canada as a potential site for future battery production facilities due to the country's vast reserves of key minerals like lithium, cobalt, and nickel, resources crucial for EV manufacturing. A tariff war could discourage Tesla from investing further in Canadian operations, pushing them to seek alternative supply chains in other regions like South America or Australia. Moreover, Tesla's success in Canada has been largely driven by government incentives for electric vehicles. If trade tensions escalate and tariffs make Tesla models prohibitively expensive, the entire EV adoption strategy in Canada could be impacted. Canadian consumers may be forced to turn to European or domestic EV brands, shifting the market dynamics. This shift could strengthen competitors like Volkswagen, BMW, or emerging domestic EV startups that would no longer have to contend with Tesla's dominant presence in Canada. Another critical factor is Tesla's reliance on international supply chains for EV components. While the company has made strides in localizing production, many essential components are still sourced from multiple countries. A trade war that disrupts Tesla's access to Canadian-supplied materials would have ripple effects on its broader manufacturing strategy, potentially delaying new vehicle models and increasing costs worldwide. Tesla's stock market performance could also be affected. As investors watch the growing tensions, concerns about supply chain instability and decreased sales in Canada might lead to fluctuations in Tesla's stock price. This could influence shareholder confidence and impact the company's ability to raise capital for expansion and new product launches. Ultimately, while Tesla is just one of many companies caught in this U.S.-Canada trade battle, its high-profile status makes it an easy target for political posturing. Whether or not these tariffs materialize, the threat alone introduces a new level of uncertainty for Tesla and the broader EV industry in North America. Can Canada replace the U.S. with the EU? Analyzing trade data, Canada's largest export destination remains the U.S. geographical proximity, and established logistics make the U.S. an irreplaceable market. On the other hand, Canada has an existing free trade agreement with the European Union under the Comprehensive Economic and Trade Agreement, CETA, which eliminates most tariffs. This means that, in theory, shifting exports to the EU could be a viable alternative. However, in reality, the challenges are significant. Transportation costs, regulatory differences, and competition from European manufacturers make it difficult for Canada to pivot away from the U.S. entirely. Could Canada truly replace its U.S. exports with EU trade? While CETA provides an open door for trade, the infrastructure required for a large-scale shift would take years to develop. Exporting heavy goods like vehicles and metals across the Atlantic is not as simple as moving them across the U.S.-Canada border. Logistical complexities, customs procedures, and market differences make a complete pivot to the EU highly unlikely, at least in the short term. Can Canada's auto industry survive without the U.S.? The North American auto industry is highly integrated. Canadian factories supply crucial parts to U.S. automakers, which are then assembled and sold across North America. If Canada were to shift its focus to the EU, it could face significant disruptions in production. Meanwhile, European automakers already have established supply chains and may not be eager to integrate Canadian parts into their manufacturing process without long-term guarantees. If trade tensions escalate, the impact on the Canadian auto sector could be devastating. Manufacturers operating in Canada would face uncertainty, potentially prompting job losses, investment pullbacks, and economic instability. Would automakers relocate production to the U.S. or Mexico to avoid tariffs? These are the questions industry leaders are now grappling with. Is Canada bluffing or playing a smart trade move? Despite these hurdles, Canada is making it clear that it has other options. By engaging more with Europe, Ottawa is sending a message to Washington. Canada is not without leverage. This could force the U.S. to reconsider its tariff plans or risk long-term damage to North American trade stability. Could Canada's threat actually work? The U.S. has much to lose if Canada diverts its exports elsewhere. A trade war would not only hurt Canadian businesses, but also damage American industries that rely on Canadian raw materials and components. If Canada follows through, the U.S. could see rising production costs and limited supply availability, especially in sectors like steel and aluminum. Will Canada cut off U.S. EV minerals? Beyond the auto sector, Canada is also a key supplier of critical minerals used in electric vehicle batteries, such as lithium, nickel, and cobalt. If Canada redirects these materials to Europe instead of the U.S., it could seriously impact American automakers. With the global shift towards EV production, these resources are more valuable than ever. If tensions continue to rise, could Canada restrict access to these minerals? Tesla and other U.S. automakers depend on stable supplies from Canada to keep EV production on track. Losing access to these critical minerals could delay EV adoption, disrupt global supply chains, and ultimately impact the U.S. economy. Will consumers pay the price? Car costs set to rise. But let's not forget about consumers. If tariffs are implemented, both Canadian and American car buyers could see significant price hikes. Automakers will pass increased costs onto consumers, potentially leading to lower demand, factory shutdowns, and job losses in both countries. The impact could be widespread, extending beyond the auto industry into agriculture, energy, and technology. Will consumers bear the brunt of this trade war? Higher tariffs mean higher prices, not just on cars, but on everything connected to the auto industry. As factories struggle to adjust, job losses could ripple across related industries, causing economic slowdowns in both Canada and the U.S. Could this escalate into a full-blown trade war? Then there's the risk of a full-blown trade war. If Canada retaliates, the U.S. may escalate further, triggering a domino effect across multiple industries. This could lead to an economic standoff with global consequences, affecting supply chains, commodity prices, and investment flows across North America and Europe. If neither side backs down, could this spiral into a full-scale economic crisis? History shows that trade wars rarely end well, and with two of the world's largest economies involved, the stakes couldn't be higher. The final showdown. Is this Canada's exit or a trade tactic? So, is Canada's pivot to the EU a serious economic strategy or a tactical move to gain negotiating power? Could we be on the verge of an all-out trade war, or will both nations reach a compromise before serious damage is done? One thing is clear: this standoff has the potential to reshape global trade for years to come. Let us know your thoughts in the comments below. And if you want to stay updated on this developing story and other major economic shifts, don't forget to like, share, and subscribe, and turn on notifications. We'll be closely following how this trade dispute unfolds.